On a quiet Wednesday morning in late 2024, something happened inside the corporate bond market that should have made front-page news but didn't. A Fortune 500 company, one that had been considered stable, profitable, and nearly risk-free for decades, failed to refinance a routine piece of its debt. Not because the company was insolvent, not because lenders were panicking, but because the cost of refinancing had jumped so fast, so dramatically, that renewing the loan under the new interest rates would have instantly doubled the company's annual interest expenses. For the first time in its history, the company paused its refinancing schedule and began selling assets to raise cash. It wasn't a headline. It wasn't a crisis. It wasn't even noticed by most analysts. But inside the world of corporate finance, it was a warning signal, one that quietly echoed across balance sheets, boardrooms, and trading floors. If you want more deep dive breakdowns like this, take a second to like, comment, and subscribe so you don't miss upcoming episodes. To understand why that moment matters, you have to go back to the 2020 to 2021 era, when global interest rates were at the lowest levels in modern history. Central banks across the world slashed rates to near zero, flooding markets with liquidity to survive the pandemic collapse. For corporations, it was an opportunity too good to ignore. Companies refinanced their old debt at rock-bottom rates, issued new bonds at the cheapest borrowing costs in decades, and extended maturities far into the future. It didn't matter whether a company was strong or struggling. If it could borrow, it borrowed. Money was cheap, abundant, and almost free. For 2 straight years, the corporate world behaved like interest rates would stay near zero forever. But interest rates did not stay near zero. They came roaring back. When inflation surged in 2022 and 2023, central banks raised rates at the fastest pace in 40 years. A decade of easy money ended in less than 12 months. The same companies that had borrowed aggressively at 1 to 2% were now facing refinancing rates of 6 to 9%. And because corporate debt operates on fixed maturities, 3 years, 5 years, 7 years, the shock wouldn't hit immediately. It would hit on a delay. The crisis wasn't in 2022, not in 2023, not even fully in 2024. The crisis was locked into the calendar, quietly waiting for the day those cheap loans expired. That day is 2025. The avalanche is 2026. Corporate America is sitting on trillions of dollars in debt that was issued when money was nearly free. That debt is now coming due in a world where money is expensive. Companies that were comfortably profitable under cheap borrowing conditions suddenly face interest bills 2 to 3 times higher than what they budgeted for. Entire profit margins vanish. Stock buybacks become impossible. Dividend payments shrink. Cash flow tightens. Layoffs become the fastest way to survive. And for companies that were already over-leveraged, refinancing becomes a life or death decision. Corporate finance analysts call this moment the refinancing wall. It is the financial equivalent of a conveyor belt. Every month, more debt matures. Every month, new loans must be issued. Every month, companies must walk into a market where lenders demand higher returns for higher risk. The borrowers cannot escape the timeline. They can only hope rates fall, lenders loosen, or markets calm. But the calendar keeps moving. By late 2024, the early cracks were already showing. Revenue growth slowed while labor costs rose. Companies with weak pricing power saw margins shrink. Higher input costs collided with consumer resistance. Balance sheets that appeared healthy under zero-rate conditions began to look fragile under 7% borrowing costs. Even strong companies started extending payment cycles, delaying capital expenditures, and quietly reducing hiring. No panic, no headlines, just careful, methodical tightening. Meanwhile, private equity firms, the silent giants of corporate America, faced even deeper pressure. During the zero-rate years, they bought companies using massive amounts of debt, expecting to refinance later at similar low rates. They paid high prices not because the companies were worth more, but because the cost of financing was historically cheap. When rates surged, the math broke instantly. Deals that worked at 2% financing failed at 7%. Companies acquired in the boom years of 2020 and 2021 suddenly became unprofitable. Interest costs ate the cash flow. Refinancing became a nightmare. And the firms that typically rescued struggling companies by borrowing more found themselves trapped by the same wall of debt. By 2025, one phrase began circulating quietly on earnings calls and private meetings: debt-sensitive companies. These were companies whose profitability depended on low borrowing costs. Many of them had business models that worked only because money was cheap. Some were in consumer discretionary markets, some in commercial services, some in technology. Many were in retail. They weren't fraudulent or doomed. They were built during an era of cheap capital. When that era ended, their balance sheets were suddenly exposed. These companies are the first casualties of the 2026 corporate debt avalanche. The magnitude of the problem becomes clearer when you examine the numbers. Trillions of dollars of corporate debt come due between 2025 and 2027. The refinancing spike in 2026 is the largest in modern U.S. history, larger than before the 2008 crisis, larger than the 2001 collapse, larger than the dot-com unwind. And unlike previous cycles, this time the problem is not isolated to a few sectors. The refinancing wall cuts across the entire economy: manufacturing, tech, retail, logistics, real estate, automotive, private equity portfolios, and even parts of healthcare. When interest expenses rise, companies face only a few options. They can raise prices, which consumers already resist. They can cut costs, which often means layoffs. They can sell assets, which weakens long-term stability. Or they can restructure their debt, which lenders may not accept. None of these solutions improve the company's position. They only delay the strain. And the more companies attempt these strategies at the same time, the more pressure builds across the system. The labor market feels this pressure next. Companies that cannot handle higher interest costs begin reducing workforce size. Some slow hiring, some freeze hiring, others cut staff in stages. A few collapse entirely, sending thousands into unemployment. And because corporate debt affects multiple sectors simultaneously, layoffs become synchronized. A slowdown in one industry spreads into others. Consumer demand weakens. Revenue drops. More companies face refinancing stress. The cycle accelerates. Meanwhile, the banks that lend to corporations face their own risks. When companies default, banks absorb losses. When companies restructure, banks receive reduced payments. When companies cut spending, banks lose business across lending, cash management, and financial services. Regional banks, already weakened by commercial real estate, face the worst exposure. A wave of corporate bankruptcies will hit them hardest, reducing their capital buffers, tightening lending standards, and amplifying the slowdown. But the most dangerous aspect of the 2026 corporate debt avalanche is its timing. It does not hit instantly. It builds slowly. It compounds. It spreads in waves. It begins with refinancing difficulty, then higher interest expenses, then profit margin compression, then layoffs, then default risk, then fire sale asset liquidations, then credit tightening, then a broader economic slowdown. It looks quiet at first, but the underlying math is unforgiving. Corporate America borrowed trillions at near-zero rates. Now those trillions must be refinanced at some of the highest rates in decades. The gap between those two realities is not theoretical. It is arithmetic, and arithmetic always wins. This is why the quiet refinancing failure of that Fortune 500 company in 2024 matters. It wasn't about that company. It was about what it represented: the first crack in a wall that stretches across the entire corporate landscape. A crack that will widen as the calendar moves closer to 2026, when the largest chunk of corporate debt in the modern era comes due. And the truth is, most people won't see the crisis coming until it is already underway. But by then, the timeline cannot be reversed. What makes the approaching corporate debt crisis so dangerous is not simply the scale of the debt or the new reality of high interest rates. It is the convergence of multiple pressures hitting corporate balance sheets all at once. The market likes to pretend that crises happen in isolation, that one domino falls, the others stay in place, and you can contain the damage. But debt-driven crises rarely behave that way. They compound, they overlap, they accelerate each other. And by the time most people recognize what is happening, the system is already deep into the chain reaction. The first major pressure is the cost of refinancing itself. A company rolling over a $500 million loan that used to cost 2% interest suddenly faces a 7% rate. On paper, that looks like a simple 5-point increase. But in real dollars, the interest bill jumps from $10 million a year to $35 million. That extra $25 million has to come from somewhere. And if the company is already operating on thin margins, that increase doesn't just hurt, it destabilizes the entire financial structure of the business. The company can no longer invest in growth, it can't maintain its existing workforce, and it can't meet its old projections. Investors downgrade their expectations, lenders tighten their offers, and the company slowly starts drifting toward a liquidity problem that didn't exist before. The second major pressure comes from earnings stagnation. Corporate profit margins expanded for more than a decade because borrowing was cheap, labor costs were contained, and global supply chains operated efficiently. But that environment ended abruptly after 2020. Labor became expensive, energy prices fluctuated wildly, supply chains broke and then rebuilt at higher costs, and consumers became more sensitive to price increases. Companies that once passed on higher costs to customers discovered by 2023 and 2024 that the consumer was reaching a breaking point. Sales slowed. Revenue forecasts weakened. Some sectors plateaued. Others shrank. When earnings stopped growing, higher interest costs no longer have a cushion to fall onto. The math becomes unforgiving again. The third pressure emerges from credit rating downgrades. When interest costs rise and earnings fall, rating agencies take notice. A company with a borderline investment-grade rating can be pushed into high-yield territory with just one downgrade. That downgrade makes refinancing even more expensive because lenders demand a higher risk premium. In 2024 alone, dozens of U.S. companies were pushed from BBB to BB, the line separating safe from speculative. Once a company crosses that line, large institutional investors, pension funds, insurance companies, sovereign funds, are no longer allowed to hold its bonds. They are forced to sell, even if they don't want to. That forced selling drives prices lower, pushes yields higher, and creates a dangerous feedback loop. The companies that most need stability suddenly face chaos in their bond prices. The fourth pressure is the behavior of lenders themselves. Banks and private credit funds know what is coming. They know the refinancing wall is approaching, and they know defaults are likely to rise. As a result, they preemptively tighten lending standards. They demand more collateral, higher interest rates, stricter terms, and shorter maturities. For strong companies, this is annoying. For average companies, it is stressful. For weak companies, it is devastating. The companies that could barely refinance at 3% cannot refinance at 8%. And those are the companies that will trigger the earliest bankruptcies. The fifth pressure is the competition for capital. When the Federal Reserve allows interest rates to remain high, investors flock to safer returns. U.S. Treasury yields become attractive. Money market funds become attractive. Suddenly, investors can earn 5% or more with virtually zero risk. That makes risky corporate debt less attractive. Companies that once relied on cheap capital markets now face a skeptical investor base. Fewer bids, wider spreads, tougher conditions. Capital flows toward the safest assets and away from the riskiest borrowers. In normal environments, this is manageable. In a refinancing-heavy environment, it is dangerous. One of the clearest signs of this growing tension shows up in private equity-owned companies. These companies were acquired using debt-heavy buyout structures when interest rates were low. They were often restructured, streamlined, and loaded with additional borrowing to pay special dividends to the owners. The expectation was simple. The cheap money era would continue, the companies would grow, and refinancing would always be available. But when rates surged, the business models cracked. These companies now face a refinancing wall with debt loads designed for a world that no longer exists. Many of them are already quietly meeting with restructuring advisors. Some are considering strategic bankruptcy as a way to escape their old debts. Others are selling divisions at steep discounts to raise cash. None of these are the signs of a healthy corporate sector. By 2025, the pressure will begin showing in quarterly earnings calls. Executives will talk about cost discipline, operational efficiency, capital optimization, and strategic adjustments. These are polite ways of saying the company is cutting spending, delaying investments, shrinking staff, and preparing for higher debt costs. Analysts will lower forecasts. Investors will demand answers. CFOs will talk about proactive refinancing, building liquidity buffers, and improving balance sheet resilience. But behind closed doors, the story will be simpler. The numbers don't work anymore. The early wave of bankruptcies will begin in the sectors most sensitive to interest costs: retailers with thin margins, logistics companies with heavy asset financing, commercial real estate operators with refinancing cliffs, manufacturing businesses struggling with high input costs, companies that need constant credit access to stay alive. These early bankruptcies will not be catastrophic. They will look like normal market churn. But every one of them will add stress to lenders, stress to bondholders, and stress to the labor market. The second wave will hit companies that are fundamentally healthy but heavily leveraged. These are not failing businesses. They are victims of timing. They borrowed too much when money was cheap and now face a refinancing cost that destroys their cash flow. They will try everything: debt exchanges, bond buybacks, asset sales, carve-outs, equity injections, cost reductions. Some will survive, others will not. The market will treat these collapses as isolated events, but they will not be isolated. They will be symptoms of the same structural pressure that is pushing through the entire economy. The third wave will hit the lenders. Banks that extended loans to leveraged companies will begin reporting rising credit losses. Loan loss reserves will increase. Lending capacity will shrink. Some regional banks, already fragile from commercial real estate exposure, will face liquidity concerns. Depositors will become nervous. Money will flow out of smaller institutions and into larger banks or money market funds. Tighter lending will reduce business investment, slow down hiring, and weaken economic activity. The cycle will reinforce itself. Meanwhile, the bond market will respond with widening spreads. Investors will demand more return to compensate for rising default risk. Companies will face even higher refinancing costs. Supply chains will slow. Investment cycles will shift. Hiring freezes will spread. Consumption will weaken. Layoffs will rise. All while the largest corporate debt wall in U.S. history continues moving closer. The most dangerous moment arrives when these pressures align. When capital becomes scarce, when defaults begin to rise, when revenue growth stalls, when interest costs peak, when layoffs spread, and when consumer demand weakens at the same time companies need the most liquidity to survive. This is the real core of the 2026 danger. It is not just the debt. It is the synchronization of stress. Historians will later note that the signals were visible well before the crisis unfolded. They will point to the early refinancing failures in 2024, the credit rating downgrades in 2025, the tightening lending environment, the rising spreads, and the quiet warnings from CFOs across the market. They will talk about how companies kept extending debt maturities during the zero-rate years and how that decision created one of the largest refinancing clusters in modern corporate history. They will say the warnings were there, and they will be right. But most people will not pay attention until the layoffs start, until the bankruptcies become headline news, until a major Fortune 500 company misses a payment, delays a refinancing, or announces a restructuring plan. And by that point, the system will already be deeper into the chain reaction than most realize. Because crises driven by debt do not explode instantly. They build pressure quietly. Then, suddenly, the pressure becomes impossible to ignore. The corporate debt avalanche of 2026 is not a prediction or a theory. It is a timeline baked into the global financial system. The debt exists. The maturities are scheduled. The interest rates are real. The refinancing wall is not optional. The only unknown is how severe the impact will be, and how many companies will fall before the cycle ends. And as 2025 progresses, the signs will only grow more visible. By the time the calendar turns to 2026, the tension inside the corporate credit market will no longer be a quiet background concern. It will become a central force shaping decisions inside boardrooms, trading floors, and government offices. The companies facing the earliest refinancing deadlines will already have revealed the first signs of strain. Some will deliver softer earnings. Others will announce unexpected layoffs. A few will withdraw guidance entirely. And a handful will reveal new debt agreements with noticeably higher interest costs. Each announcement will look small in isolation, but together they will form the first visible layer of a structure buckling under financial pressure. Markets will try to stay calm, as they always do. Analysts will argue that the stress is manageable. Economists will say the system is resilient. Commentators will insist that the worst-case scenarios are unlikely. But behind the scenes, the people who actually manage balance sheets, allocate capital, and measure liquidity will be preparing for a very different reality. They will see what history has shown repeatedly, that debt cycles rarely break softly, and when pressure builds across multiple sectors simultaneously, the transition from stability to instability can be sudden and nonlinear. That transition often begins with liquidity, the most fragile element of a heavily indebted financial system. Companies under pressure will start drawing down credit lines that were once rarely touched. They will begin raising capital through private credit funds at much higher costs. They will sell equity at weaker valuations. And they will accelerate efforts to reduce expenses ahead of refinancing negotiations. None of this will appear overly dramatic at first, because large corporations know how to mask early stress. But the credit markets will recognize the signals: higher demand for short-term liquidity, more bridge financing deals, more distressed debt buyers entering negotiations, and more companies approaching lenders for extensions or amendments. As liquidity tightens, the next layer of stress will hit supply chains. Companies forced to protect cash flow will reduce inventory levels, delay new orders, and renegotiate payment terms with suppliers. Smaller suppliers, already operating on thin margins, will feel the squeeze first. They will struggle to obtain credit, struggle to maintain inventories, and struggle to meet customer demand. A few will shut down, triggering disruptions that travel up the supply chain. Larger companies will be forced to source alternatives at higher costs or face production delays. None of these issues will be catastrophic individually, but together they will contribute to a slow erosion in operational stability, adding pressure at exactly the wrong moment. Then the labor market will feel the impact more sharply. Companies with rising interest expenses and tightening liquidity will turn to the fastest cost-cutting mechanism available, reducing payroll. Some will trim bonuses. Others will scale back over time. Many will quietly freeze hiring. And the companies under the greatest strain will begin cutting entire departments or closing locations. The early layoffs will seem modest, scattered across industries, and easily dismissed as cyclical adjustments. But as refinancing deadlines approach, the layoffs will become more synchronized, particularly in sectors with heavy debt loads and narrowing profit margins. The job losses themselves will weaken consumer demand, which will then reduce revenue for companies still trying to refinance. This is how debt cycles turn into economic slowdowns, through feedback loops that expand gradually, then rapidly. One of the most important turning points in any debt crisis occurs when investors begin demanding higher returns not just from struggling companies, but from companies across the entire risk spectrum. This is the moment when fear becomes systemic. Corporate bond spreads widen. Investment-grade debt becomes more expensive. High-yield credit markets weaken. Private credit funds charge aggressive terms. Capital becomes scarce. Companies that would have easily refinanced a year earlier find themselves trapped. Even strong companies feel nervous. CFOs become cautious. Boards approve fewer investments. Stock buybacks slow. Corporate America becomes defensive. In moments like this, history provides warnings that are impossible to ignore. The 1998 long-term capital management crisis, the 2001 dot-com unwind, the 2008 credit meltdown, all of them began with tightening liquidity, rising spreads, and borrowers struggling to roll over debt. None of those crises were identical, but all shared the same foundation: too much leverage hitting a sudden change in the interest rate environment. The exact trigger differed each time, but the underlying physics were the same. When debt becomes too expensive and access to refinancing shrinks, the system breaks at its weakest points first, and then the shock spreads outward. As 2026 unfolds, attention will turn to the companies most exposed to the refinancing wall. Some of them will survive with painful adjustments: asset sales, dividend cuts, restructuring deals, or emergency equity raises. Others will fail. The failures will not be random. They will cluster in industries that borrowed aggressively during the cheap money years. They will cluster in companies owned by private equity firms that prioritized financial engineering over operational resilience. They will cluster in sectors that rely on constant credit access to operate: retail chains, telecommunications providers, logistics companies, and manufacturers with high fixed costs. These early failures will not collapse the system, but they will send signals that cannot be ignored. The markets will then shift their attention to the financial institutions holding the most exposure. Regional banks will face particular scrutiny. especially those with concentrated exposures to commercial borrowers. Their balance sheets will be examined more closely. Analysts will dissect their loan portfolios, their liquidity levels, and their capital ratios. If even one regional bank shows signs of distress, depositors may react quickly, shifting money into larger institutions or money market funds. This dynamic already appeared in 2023 and will reappear more aggressively under the weight of the corporate refinancing wave. Banks facing pressure will tighten lending even further, accelerating the slowdown in business investment and worsening the financial conditions for companies still seeking refinancing. Government officials and regulators will attempt to calm markets. They will talk about the strength of the financial system, the resilience of corporate America, and the ability of the Federal Reserve to manage instability. They will highlight reforms made after 2008. They will emphasize liquidity tools. They will try to reassure the public. But the effectiveness of those messages will depend on the severity of corporate defaults. If the failures are contained, confidence will stabilize. If the failures spread, confidence will erode quickly. Meanwhile, the bond market will send its own signals. In every major credit downturn, bond investors see the danger before the stock market does. They notice deteriorating cash flow first. They detect rising refinancing risk earlier. They see defaults forming beneath the surface long before they appear in earnings. By the time corporate defaults rise noticeably, the bond market will already be deep into risk-off mode. Spreads will be wide. Yields will surge. New borrowing will be expensive. Companies will be forced into painful decisions. This is where the corporate debt avalanche becomes most dangerous. Once a critical mass of companies is unable to refinance at sustainable rates, the system enters a new phase: forced deleveraging. Companies sell assets not because they want to, but because they must. Some reorganize under bankruptcy. Others undertake fire sales to private equity firms with cash. Entire divisions of once-strong corporations may be spun off, shut down, or merged. This reduces corporate capacity, reduces employment, reduces investment, and reduces the overall momentum of the economy. At this stage, the question becomes not whether the corporate debt crisis will impact the broader economy, but how deeply it will cut and how long the recovery will take. An economy with synchronized corporate deleveraging behaves very differently from one experiencing a simple recession. Deleveraging takes time. It slows growth. It weakens confidence. It creates caution across households, businesses, and lenders. It reshapes the economic landscape in subtle ways that last long after the crisis itself has passed. By the end of 2026, the story will be clear. The companies that prepared early, those that strengthened balance sheets, reduced leverage, built liquidity, and extended maturities, will emerge stronger. The companies that ignored the signals will face restructuring, forced mergers, or liquidation. Some will disappear entirely. And when economists look back at the era of near-zero interest rates from 2009 to 2021, they will recognize a pattern that has replayed through financial history. When money is artificially cheap for too long, companies overborrow. They take risks they cannot sustain. They assume refinancing will always be easy. And when the cost of capital returns to normal levels, the consequences arrive with mathematical certainty. The corporate debt avalanche of 2026 will not be remembered as a sudden shock. It will be remembered as a slow, predictable, unavoidable reckoning. A crisis built not in a single year, but over an entire decade of distorted incentives. A crisis that followed a simple rule of financial physics. Cheap money creates fragile structures, and fragile structures eventually break. And when the public finally understands what happened, they will ask why no one warned them. But the warnings were always there, in the debt issuance numbers, in the maturity schedules, in the rising interest rates, in the earnings calls, in the credit downgrades, and in the quiet failures that began years earlier. Crises driven by debt do not hide in the shadows. They announce themselves through the math. And math always wins.